A warm welcome to Market Pulse by SC Securities and Daily FT. I'm Dilusha Gamage, and today I'm in conversation with Mr. Charita Gunasekara, the Head of Research of SC Securities Private Limited. Charita, welcome to Market Pulse. Charita, to start off the conversation, now we are at a very unprecedented time, and the investment community is also a bit confused and worried. And how can they mitigate risk now onwards? What should be their way forward strategy?
Thanks, Dilusha, for inviting me. I think the basic principles of investment holds true in any market condition. Right now, you see a lot of uncertainty. You see that the economy is trying to, it's going through some rebalancing activities. So, with all this happening, I think the basic principle of investment is you have to diversify your portfolio. So if you are in just one particular asset class, right, you're always faced with a greater level of risk. Let it be equity or fixed income or other commodities. So that is always there. So I think to answer your question, Dilusha, what investors should do is they should diversify their portfolio. What I mean by diversifying is moving into different asset classes, and even within the same asset class, you have to look at different exposures. For example, if you look at equity investments, you should diversify your portfolio into different industry sectors, right? You should diversify into manufacturing, you should diversify into telecommunication, you should diversify into financial services, right? The second thing is that you have to identify, especially in an uncertain environment like this, you should identify industries as well as companies that would be immune to the changes what we are seeing. Now, we have seen that interest rates have increased. We have seen that the rupee have depreciated. So all these are necessary for the economy to rebalance. So with that, what should investors do? Are they to move away completely from equity? I would say no. You should always diversify your portfolio, but there's a lot of scope for investors to generate much higher returns in equity compared to the high rates what you're seeing in fixed income securities. Now, what investors can do is basically, I think many analysts also pointed out in our previous discussions that people should look at export-oriented companies. Yes, there are companies listed in the Colombo Stock Exchange which is immune to the foreign exchange depreciation, the rupee depreciation. And some of them are actually benefiting out of them. So you should focus on those companies. Then the other thing is you should look at companies who are not vulnerable to these changes. Now, for example, renewable energy companies are not affected by these changes that are taking place, right? So that's another good sector investors can look at. Thirdly, I would say even the property sector, land and building sector. That sector would also benefit as a result of this increase in construction cost. So I think that's the way forward investors should look at. And lastly, you should also look at high dividend paying companies. Now with the drastic decline in share prices, most companies, the dividend yield has gone above 2 digits. So focus on those companies because those companies can give you returns higher than some of the fixed deposit rates what you can yield from a bank. Fixed deposit rates as we talk right now is around 13%. So there are companies with dividend yields in excess of that.
And Charita, now if you can give us few examples of some specific recommendations that you would be giving to investors, what would be those stock picks?
Yeah, I would, with this given context, with these high interest rates, you should focus on companies which are cash rich. And you should try to prevent in investing in companies that are highly geared. So any company which is highly geared would face a large increase in finance cost. Companies with high cash reserves will show significant increase in their finance income. So just to name one, I'd say John Keel's, just an example, has a very high cash reserve. So that company can benefit. Then even the insurance companies would benefit out of this increase in interest rates. Then moving on to dollar-based revenue companies, companies who are operating outside Sri Lanka, earning revenue in dollars with minimal exposure in Sri Lanka, those companies would definitely benefit out of it. And especially the manufacturing sector companies who are exporting and the ones who are sourcing raw materials locally would be the least affected export sector companies. So those, I think, would be ideal investments, and their future earnings are supposed to improve.
Okay, Jaita, now you were talking about the currency depreciation. So when the rupee depreciates, it's quite attractive for foreign investors to come in. So what is your view on the foreign investments? Will there be some interest in the Colombo Stock Exchange, and how will that work in the future?
Yeah, if you look at the exchange rate environment, Dilusha, since the rupee was floated, we have seen fundamentally strong shares have attracted foreign buying. Now, the rupee has depreciated approximately 70% since it was floated. And in the same time, most of the fundamentally strong shares, the share price have come down in the range of 50 to 60%. So Sri Lankan equity has become extraordinarily cheap to foreign investors. So that's why you see that foreigners are actually accumulating shares of fundamentally strong companies. Having said that, moving forward, if we are to attract more foreign investments, what foreign investors would look at is a more stable exchange rate. For that to happen, I think there has to be some consolidation in the exchange rate. Now, one positive thing is that we are as a country, we are in dialogue with the IMF. So any IMF package that would come towards us would be an acknowledgement of the reforms that are taking place. It would acknowledge that the country is moving forward in the correct direction. That would result in other funding agencies also to lend funds to the country, and that could lead to foreign investors making investments in foreign portfolio investments as well as foreign direct investments. So I think it's an opportune time for foreign investors to come and accumulate shares in Sri Lankan markets.
And also, Chaita, we have been talking, keep on talking about the interest rates hike. And well, these levels of interest rates, this is not the first time we are seeing these levels of high interest rates. And also, how did the market reacted when the interest rates have gone up like this in previously? And also, what is your take on the next the upcoming days? How will the market react for the policy rate hikes?
Yeah, during my 15 years career in local capital markets, Dilusha, I have seen inflation high as 28%. I have seen interest rates at these levels. So even at those times, we didn't see that share prices melting down like this. So there had been cycles in the past as well. So through my experience, what I can say is the investors who were bold enough to look at company-specific details rather than looking at the overall market and finding value investments and accumulating those shares were the absolute winners of this equity market. What happens is when the market is on a bull run, people just start buying shares at unrealistic prices. And ultimately, when the correction happens, there's a lot of pain. But if you are a long-term investor, I think this is the best time to do that because Sri Lanka has experienced high interest rates and high inflation rates earlier, and exchange rates also have been going up steadily. So despite that, if you look at company specifics, if you can identify the real fair value of shares and see whether the share is trading below these fair values and do value investing, I think the ones who do that would be the absolute winners in a couple of months or maybe 1 or 2 years' time.
Okay, Chaita, so last but not least, what would be your final message or the advice to the investors?
Yeah, Dilusha, we saw that during the last couple of weeks, certain shares come down for no reason, right? So those shares, if you look at the company specifics, those companies are absolutely doing well. Some of these companies, as I mentioned before, they are immune to all what is happening here. So that is mainly due to the herd instincts. People are just following the trend and selling out shares of fundamentally good companies. So my advice is, don't look at the overall index in the market and be misled. Just look at the individual companies and see whether the current share price could be justified, right? If you can see that these current share prices are way below their true intrinsic value, I think you should take a stance and you should hold on to those shares. And you have to restructure your portfolios. Definitely, investors would be moving out funds into fixed income securities because fixed income securities are giving a very high return, high as 24% on treasury bills. However, if you look at the inflation rates, the National Consumer Price Index, NCPI, is approximately 22%, right? So you are having a marginal return, or sometimes it's a negative return. So you should diversify your portfolio, as I said, to mitigate your risk, but at the same time, don't follow the herd instincts. Do your homework, look at specific companies, and if a particular company is doing well, irrespective of the market condition or irrespective of the economic condition, you should accumulate such shares.
Thank you very much, Charita, for joining with Market Pulse and also sharing your valuable insight with us. And ladies and gentlemen, you are listening to Charita Gunasekara of the Head of Research of SC Securities, and this is Market Pulse. Thank you for joining with us.
For more latest news, subscribe to FTTV.